Welcome to this explainer. Look, if you're a young professional out there trying to build your very first portfolio, you're basically standing at a massive crossroads right now. Today, we're going to explore the two vastly different paths you can take to build wealth. One of these paths, well, it's chaotic, it's incredibly stressful, and honestly, it almost guarantees long-term failure. The other path, though, is surprisingly simple, it's highly automated, and it is statistically proven to make you wealthy. As your financial educator for this explainer, I am absolutely thrilled to show you exactly why simplicity consistently, and I mean consistently, beats complexity when it comes to your money.
To really wrap our heads around the difference between these two paths, I want to introduce you to our cautionary tale. Let's call him Dave. So Dave's been actively trading for a couple of years, and in a roaring bull market, the guy looks like an absolute genius. He hits it big on some high-risk crypto meme coin, and suddenly he's booking tables at Nobu, utterly convinced he's the next Wall Street wizard. He's hyperactive, leveraging his whole portfolio with out-of-the-money options. But when the market inevitably reverses and the Fed hikes interest rates, Dave's chaotic strategy completely collapses. His portfolio plummets 67%, and suddenly our little market wizard is frantically Googling jobs at Payway. Dave is pretty much the perfect example of why chasing complexity always leads to ruin.
Okay, let's dive into this. We've got a really clear, structured playbook to help you avoid Dave's fate and build a rock-solid portfolio. We're going to start with the trap of dumb money, then move into plugging your financial leaks. After that, we'll look at why simplicity beats complexity, the sheer power of automation, and finally, how to reach that magical first $100,000. All right, kicking things off with Section 1, the trap of dumb money, or why reckless trading feels amazing right up until it doesn't.
We really need to unpack the psychology behind a new investor's massive initial confidence and why that exact confidence fundamentally sets them up for failure. You see, the reason active traders like Dave get so overconfident is deeply rooted in psychology, specifically something called the Dunning-Kruger effect. This is a cognitive bias where absolute beginners vastly overestimate their own abilities. But here's the real kicker. We've been sitting in a historically massive bull market. I'm talking about a 17-year run with 715% returns. When the entire market is surging like that, it completely masks bad investing. Novice traders will buy a random meme coin, it goes up just because literally everything is going up, and they immediately assume, wow, it must be because of my sheer brilliance.
Now, what's really interesting about this slide is how the actual mechanics of volatility play right into that overconfidence. Let's look at a concept called beta. Beta measures how volatile a stock is compared to the broader market. So, if Amazon has a beta of 1.33, it means it's 33% more volatile. Now, in a booming market, young investors flock to these high beta, super volatile assets. When the market goes up 2%, their portfolio might jump 3 or 4%. It drastically inflates their egos. But listen, beta works both ways. When the market inevitably turns, that high beta portfolio feels the full crushing effects of gravity, dragging them right down to rock bottom.
Moving right along to Section 2, plugging your financial leaks, fixing the bucket before trying to fill it.
So we're going to pivot away from the flashy, chaotic failures of active trading for a second and look at the quiet, everyday habits that secretly drain wealth from otherwise highly successful young professionals. Because honestly, you can have the best investment strategy in the world, but it will not matter at all if you suffer from leaky bucket syndrome. This is what happens when you earn a fantastic salary, maybe even 6 figures, but you lose all your wealth to hidden, untracked daily expenses. You just cannot outinvest bad spending habits. Pouring your hard-earned money into a portfolio while completely ignoring your massive daily spending leaks is quite literally like trying to fill a bucket that has giant holes right in the bottom.
So how do we actually plug those leaks? Well, here are 3 essential steps you absolutely have to take. Step 1, track your spending flows. You just can't fix what you don't measure, right? Step 2, build a basic emergency fund of at least $400. Now, I know that sounds like a tiny amount, but it's a shocking fact that 1 in 3 Americans cannot cover a $400 emergency without going into debt. That's wild. And step 3, curb appearance-focused spending. Stop buying things just to look successful to your peers. The truly wealthy are out there driving older cars and living modestly, while the folks trying so hard to look rich are often the ones going completely broke behind the scenes.
Let's jump to Section 3, simplicity beats complexity, the undeniable math of patient investing.
And this brilliantly illustrates what happens once your bucket is patched, and it's time to look at the reliable path. The undeniable math of systematic, boring index fund investing just consistently destroys chaotic stock picking. Look, over the past century, the S&P 500 averaged a 10.7% annual return when dividends were reinvested. But if you took those exact same dividends as cash to spend, your return dropped to 6.6%. Now, that 4% difference might seem pretty tiny today, but over 30 years, it's the fundamental difference between retiring securely on a beach somewhere and wondering how you're going to pay your light bill. Reinvesting your dividends is literally the ultimate wealth snowball.
And that brings us to the ultimate comparison: active market timing versus consistent indexing. Dave tries to time the market, right? He's selling when he thinks it'll drop, buying when he thinks it's safe, but the math here is brutal. If you miss just the 10 best days in the stock market over a 30-year period, your total returns are cut almost in half. No way, right? But it's true. And those best days usually happen right after the very worst days, when everyone else is panicking. The foolproof method is to just buy a broad S&P 500 index fund, ride out the crazy volatility, and let the greatest companies in America do the hard work for you.
Notice that tiny little number, 0.9%. That tiny decimal represents the typical fee difference between a complex, actively managed mutual fund and a simple, broad market index fund. It seems entirely insignificant, right? Wrong. Because investment fees compound exactly like your returns do, except they compound against you. Over a 30-year investing lifetime, that seemingly harmless 0.9% leak can silently drain hundreds of thousands of dollars from your portfolio. Seriously, keep it simple and keep your fees low.
Which brings us to Section 4, the power of automation. Protecting yourself from your own impulses.
Listen, human willpower is a finite resource. If you have to actively wake up and choose to save money every single month, eventually you're going to fail. It's just human nature. The wealthy build systems that operate completely without needing daily motivation. So here are your absolute essential automation tactics. First, pay yourself first. Before you pay rent, before you buy groceries, automate a transfer straight into your investments. Second, and this is huge, maximize your employer 401k match. If your company offers a 50% match, that is an immediate, guaranteed 50% return on day one. It is quite literally the only guaranteed winning lottery ticket in the entire financial world. Take it. Third, automate your tax-advantaged IRA contributions so you get a discount on building wealth. And finally, divert your salary raises directly into your investments before you even get used to having the extra cash.
That last point, that is exactly how you avoid lifestyle inflation, which is, without a doubt, the ultimate trap for young professionals. You start out making $40,000 a year, driving a practical Honda Civic. Then you get a raise to $60,000, and suddenly you convince yourself you deserve a BMW. Your income went up, sure, but your wealth didn't, and you are still living completely paycheck to paycheck. By automating your raises directly into your portfolio, you maintain your current lifestyle while your wealth scales exponentially. You are using your extra cash to buy actual freedom, not just nicer stuff.
Finally, we arrive at Section 5, the first 100,000, reaching the tipping point.
Everything we've discussed today is specifically designed to get you to this one singular tipping point where the entire math of your life fundamentally changes. So the crucial point is that when you cross that $100,000 threshold, your money officially becomes an employee. Think about it. When you only have a $5,000 portfolio, a 10% return is just $500. It's barely noticeable. But a 10% return on $100,000, that generates $10,000 of pure growth in a single year without you lifting a single finger. Suddenly, your money is working almost as hard as you are at your day job. This is the exact moment you transition from being just an active saver to a true passive wealth builder.
Let's move to and see how this builds. This momentum perfectly illustrates one of the most famous quotes in all of investing. The legendary Charlie Munger famously said, "The first 100,000 is the hardest." And man, it is so true. Building that initial foundation requires a real grind. It means maybe getting a roommate to slash your housing costs. It means driving the older car. It means making strategic, real sacrifices. But once you push that boulder up the hill and hit that six-figure mark, the sheer undeniable momentum of compound interest just takes over entirely. The next 100,000 comes significantly faster, and it feels a whole lot less like a struggle and much more like riding a massive wave.
I want to leave you with this final, really important thought. Your future self is out there, waiting for you 10, 20, or even 30 years down the line. What kind of gift are you going to give them? Are you going to hand them the stress, the panic, and the chaos of Dave's high-risk, volatile illusions? Or are you going to hand them the quiet, compounding, absolute security of a simple, automated index fund portfolio?
The choice to abandon complexity and embrace the reliable path to real financial independence starts with the exact decisions you make today. Thank you so much for joining me for this explainer, and remember, keep it simple.